Just last month I was helping a new client who moved back to India recently after spending 12 years in the United States. He was aware that he qualified for an RNOR status and had read many things online about it. But what he actually understood about RNOR was full of misconceptions. That's when I realized how crucial it is for us to clear up the misconceptions around this special tax category. However, before we jump into these misconceptions, let me quickly tell you what RNOR tax status actually is. Think of RNOR as a transitional tax category designed specifically for returning NRIs. It's Indian government's way of giving you a soft landing when you move back to India after living abroad. Now, when you have an RNOR tax status, you get a significant tax benefit, which is most of your foreign sourced income is exempt from Indian taxation. This can include your foreign investment returns, your rental income from your overseas properties, and even foreign pensions. But as we'll see, this protection isn't absolute, and the misunderstanding of the nuances could cost you dearly. Let's start with the first misconception, that is, that all foreign income is automatically tax-free for RNOR. While most foreign income is indeed exempt from taxes, there is a critical exemption that many returning NRIs miss. If your foreign income is derived from a business that is controlled from India or a professional setup in India, that income is taxable in India. Even during your RNOR period, you have to make sure about this. Let me explain this with an example. Say you are a digital consultant who moved back to India but still offers services to clients in US or UK. If you are managing these client relationships and performing the work while physically being present in India, this income would be taxable in India despite being paid in your foreign bank accounts. Now, the key determining factor is that where the business is controlled from, not just where the money is being received. Many US NRIs come back with their S Corp and C Corp active, but this is where it can get tricky. This also brings me to my next misconception. I encounter amongst returning NRIs the belief that RNOR means absolutely no taxes in India. This is flat outright wrong and can get you in serious troubles with the tax authorities. You need to understand that RNOR tax status only exempts you from foreign sourced income from Indian taxation. Now, any income you earned or received in India is still fully taxable. This includes your rental income from Indian properties, interest on your NRO accounts, NRE accounts, dividend from Indian income, dividend come from your Indian companies, and any salary or business sources of income that are generated in India. I had a client who returned from Canada and assumed that his RNOR status meant that he didn't have to declare his Indian rental income or interest from his FDs in India. He was shocked when I explained it to him that these were fully taxable in India regardless of his RNOR tax status. The exemption only covers what's earned outside of India. The third misconception is particularly dangerous. Many NRIs returning believe their RNOR tax status lasts indefinitely for as long as they wish. Now, this couldn't be further from truth. RNOR is a temporary status typically lasting for up to 3 financial years after your return to India, depending on how long you were an NRI before returning. The exact duration depends on which qualification criteria you meet under the Income Tax Act. So let me break down this in simple terms. You qualify as an RNOR only if you were a non-resident in India 9 out of the 10 previous financial years, or you have been in India for 729 days or less during the previous 7 financial years. Once you no longer meet this criteria, you automatically become a regular resident for tax purposes, and all your global income becomes taxable in India. Now, planning your finances around this transition is crucial and avoids tax shocks. Now, this one particular misconception has cost many of NRIs significant sums in taxes. The belief that the interest earned on NRE and FCNR account remains tax-free forever. In reality, the interest is only tax-free while you are an NRI or in an RNOR status. Once you become an ordinary resident, the interest earned on your NRE deposits is also fully taxable in India. There is, however, a solution that many returning NRIs aren't aware of. You can transfer these funds to an RFC account when you return to India. The interest earned on RFC account continues to be tax-free, even if you become an ordinary resident. Now, I strongly recommend that returning NRIs should convert their NRE and FCNR accounts to RFC accounts before their RNOR status expires. Missing this step could mean paying taxes on interest that could have remained tax-free. One more dangerous assumption many make is that RNOR status is automatically applied. In reality, your residential status is determined in each financial year based on your physical presence in India and your prior residential status. You must carefully calculate your days in India and apply the relevant criteria. What's more, while filing your tax returns, you must explicitly indicate your RNOR tax status. The tax authorities don't automatically categorize you. It's your responsibility to claim the status correctly and be able to provide the appropriate documentation. And speaking of documentation, many returning NRIs underestimate its importance. Maintaining a proper record, including your passport with your travel stamps, your boarding passes in some cases, your bank statements, which shows foreign transactions, some documentation of your NRI period is very essential to this process. If you are ever questioned about the tax authorities, these records will be your best defense. Also, one more thing which is surprising is that RNOR status is not widely known. Even many bankers and financial advisors in India are not aware of it. I've had clients tell me that their local bank manager or accountants never mentioned about this option. Now, this lack of awareness extends to many tax professionals as well. Unless they specialize in NRI taxation, many practitioners have limited experience of RNOR provisions. This is why it's crucial to work with advisors who specifically have an expertise in cross-border and taxation and NRI issues. The final misconception I want to address is the belief that RNOR tax status somehow shields you from your Indian tax obligations. As we have discussed, RNOR status only protects your foreign sourced income and not only in case of business income. Moreover, once your RNOR tax status expires, your global income becomes taxable in India, unless protected by the DTAA provisions. So in these specific cases, understanding how DTAA works is very crucial for your long-term tax planning after your RNOR period ends. So the misconceptions we have discussed today are unfortunately common, but now you are equipped with the knowledge to avoid these pitfalls. Remember, RNOR status is valuable, but it's just a temporary benefit. Use it wisely to reorganize your global assets and the plan for the long term. Proper planning during your RNOR years can set you for the tax efficiency even after you become a resident in India. So if you found this video helpful, don't forget to subscribe to our channel and join my NRI only WhatsApp community, for which the link is in the description below. If you are an NRI who is planning to return back to India and is confused about how to handle these tax complexities, feel free to reach out to us on our WhatsApp number, or you can book a consultation with us from our website, which is primewealth.co.in. Thank you, and I'll see you in the next.